Hello and welcome to the Tax Roundup for April. And the tax changes are coming through thick and fast through Parliament at the moment. Michael's going to take you through the legislation that's been introduced on the small business CGT exemptions and what that actually means and what the differences are to the exposure draft that we only covered last month. We're also going to take a look at the changes for property developers and how GST is remitted. That is now law. And also some of the other changes too to the main residence exemption. That legislation is before Parliament and has just come out of committee. So we'll explain the implications of that. But first up, Michael is going to take you through single touch payroll, which takes effect from 1 July 2018.
Now we need to talk about single touch payroll because the start date for this brand new system or way of interacting with the ATO is due to commence on 1 July 2018. The reason we need to talk about it now is because 1 April 2018 is a key date. That's the date that all employers have to undertake a headcount. If the employer has 20 or more employees as at 1 April 2018, then they must use single touch payroll from 1 July 2018. Now that headcount is not done on a full-time equivalent basis. It's just simply, do you have 20 or more employees at all? Now that could be part-time, full-time, it could be casuals as well. It could be overseas employees. So we do that headcount at 1 April 18. Don't have to send that information to the ATO, you just need to keep an internal record of that. If you do have 20 or more employees at 1 April 18, then basically you're classified as a substantial employer. And what that means is you are now forced into single touch payroll from 1 July 18, even if your headcount then drops below 20. The only way out of single touch payroll in that case is actually to apply to the ATO and receive an exemption. So you've actually got to apply to the ATO and wait for the ATO to say, actually you're now out of single touch payroll. Now, before you then jump in and do that, remember that a bill has just been introduced to Parliament which seeks to extend single touch payroll to all employers from 1 July 2019. So there would only be a very limited time where you'd be out of the system and then forced back into it again anyway. Now that bill isn't law yet, but it's working its way through the system at the moment. Now single touch payroll, for those who haven't really looked at it in detail, basically is where your software, the employer's payroll software, when you pay the employee, you're automatically telling the ATO that that's happened. You're telling the ATO PAYG withholding details. When super payments are made for employees, that is also reported to the ATO as well. So the ATO knows in real time when payments are being made, and the ATO can much easily track whether an employer is meeting their obligations when it comes to PAYG withholding and super guarantee as well. And the aim of this obviously is to protect revenue from the ATO's point of view, but also protect workers. Make sure that the ATO can identify early where workers might be missing out on their superannuation entitlements and actually take earlier action to seek recovery of those amounts from employers. Now I mentioned this bill that it seeks to extend single touch payroll to all employers from 1 July 2019. That bill also makes a number of other changes to the super guarantee system. That's something that people will need to get across as that works its way through the system. For example, when reporting through single touch payroll, you will also need to factor in salary sacrifice super contribution amounts. And again, that's just so that the ATO can figure out exactly where things stand from a super guarantee point of view. Because a lot of you will realise that the government is changing the way the super guarantee rules work so that when an employee enters into a salary sacrifice arrangement to make super contributions, that does not reduce the employer's super guarantee obligation as it has in the past. So the government's making moves to fix up that, what the government sees as a bit of a loophole or a bit of a flaw in the system. That will also begin to be factored into single touch payroll. And so in the future, you'll see that there's an obligation to report not only the salary and wages that are being paid to employees, you'll also have to let the ATO know salary sacrifice amounts as well, which relate to super contributions. So quite a fair bit happening. Key dates at this stage are 1 April 18 for that headcount to be done, and then 1 July 18 will we start off having to use single touch payroll for those slightly larger employers.
Now across to Michael on those changes to the small business CGT exemptions.
Now, it's only a month ago that we were getting our heads around draft legislation that Treasury had released in relation to proposed changes around the small business CGT concessions. And this is something that came out of the federal budget in 2017. Now, a month ago, we were looking at these draft changes, and the government's plan to proceed with those changes from 1 July 17. Even though we only saw details of the changes in February 2018, the government has now released a bill, gone into Parliament, which contains those changes in a slightly modified version. And if you compare the bill to the draft law, you'll see a lot of similarity, but there are some key differences as well. The government has said that it is going to continue with a 1 July 17 start date. So it is important to realise that clients may have already undertaken transactions on or after 1 July 17, and it may have looked like they would satisfy the conditions to access the small business CGT concessions. Well, unfortunately, with the release of this bill, and it looks like impending changes to the rules, that will all need to be revisited. Now, I want to reiterate that these rules are targeted at very specific types of CGT events. The changes are really aimed at situations where a CGT event happens and a capital gain arises in relation to a share in a company or an interest in a trust, like a unit in a unit trust. It really doesn't seem like these changes impact beyond that. So it doesn't look like these changes will impact on the sale of business premises, the sale of goodwill or other assets, regardless of whether they're held by a company or a trust, etc. Now, there may well be flow-on impacts when that happens. For example, if you've got a company that has used the 50% active asset reduction, there may be some issues in terms of getting that out of the company in a tax-effective way. Same with a unit trust. There might be flow-on CGT events that occur when you're trying to get that exempt amount out of a company or trust, in which case you may well need to consider these changes at that step, at that level. Just to run through some of the main features of the bill and where there's a bit of a difference between the draft version that we were looking at a month ago compared to the version that we have today. Under the draft version, one of the conditions that would need to have been met to access the small business CGT concessions, for example on the sale of a share in a company, was that you not only had to test the taxpayer selling the shares, but that certain tests also needed to be applied at the company level. One of those tests was you had to confirm or check that the company carried on a business just before the CGT event. Now that condition has been removed. And that's good news because lots of situations you could potentially come up with where you might be selling shares in a company or units in a trust where the assets held in that company or trust are genuinely active business assets, but that entity may not have been carrying on a business in its own right just before the CGT event. So it appears that that condition has now been removed. One of the other changes comparing the draft version of the rules to the bill that's gone into Parliament is around the 80% test for whether shares or units in a trust are active assets. Now, in very broad terms, the 80% test basically says that in order for a share in a company to be an active asset, you need to look at the assets held by the company. And at least 80% of the gross market value of those assets need to be active assets or used in connection with a business. Now, these changes modify the way that you apply the 80% test, and there's a fair bit of complexity that goes into working through those rules. But one of the areas where there's a bit of difference between the draft rule and the bill is when it comes to things like cash and financial instruments. Now, under the current rules, cash and financial instruments are deemed to be active assets for the purpose of that 80% test if they're inherently connected with that company's business activities. The draft rule was seeking to severely restrict or limit the situations when cash or financial instruments could be treated as active assets under that test. For example, they had to be trading stock or fall within certain other very limited categories. Now, because of the way the active asset test works, because we're not testing at a point in time, we're testing over a period of time, there were serious concerns that shares which have been active assets under the current rules for many years would all of a sudden lose that status because of the way that cash and financial instruments would be treated under the new rules. Now again, there's been some relaxation of that. So there are some new integrity rules that look like they're going to be introduced around cash and financial instruments, but it looks like, on the face of it anyway, that it will be a bit easier to treat cash and financial instruments as if they were active assets when we're looking at that 80% rule or that 80% test. Now, it is not going to necessarily be easy to work through these new rules. They are complex. You will really need to spend some time getting into the detail to figure out whether clients are still able to access the concessions for events happening to shares in a company or units in a trust. But it does look like we're getting to the point where at least we have a bit more clarity on what these rules look like, and we'll actually be able to start to figure out likelihood of whether clients are able to access or not access the concessions. So remember, start date looks like it will be 1 July 17. Any events that have occurred from that date onwards will need to be revisited, retested to see where clients stand.
Continuing with legislation, Michael's going to take you through those changes for property developers and also the main residence exemption.
Now, there's a lot been happening at government, parliament level over the last month or so, and we have seen some developments on some announcements that were made some time ago. Now, one of those key developments is around the rules for property sales and the way GST is dealt with. So in the federal budget, a little while ago, the government said that what they wanted to do was improve the integrity around the GST system on property transactions or certain property transactions. And what the government's decided to do is basically to pass on the obligation for paying the GST amount to the purchaser of the property, rather than it resting entirely with the vendor or the person selling the property. Now, that legislation has now passed through Parliament. Looks like it will be effective from 1 July 2018. So do need to keep an eye on that, because from 1 July 2018, someone purchasing property may well have an obligation to pay a significant amount to the ATO. Now, something we've touched on in previous versions of the tax roundup. Now, one of the key things to realise is that even where the property sale qualifies for the margin scheme, so there may well be a relatively small actual GST liability, the purchaser still has an obligation to pay the full GST amount as if the margin scheme hadn't been applied to the ATO upfront. So at settlement, they pay the GST amount, the full GST amount on the sale proceeds to the ATO. If the vendor has been able to use the margin scheme, then it's really up to them to then do step 2, which is to apply for the ATO to get some of that money back again. This is all around integrity, some concerns around what was happening in the property industry, property development industry, and GST amounts disappearing into a black hole and leaving the ATO with no way to recover it. But the bad news is it really pushes the obligation onto the purchaser to actually recover and pay some of that GST amount to the ATO. So 1 July 18 is the start date for those new rules. Hopefully lawyers will be on top of this, conveyancers, other parties involved, but don't assume that. Particularly as these new rules are new, over that first initial period, you'll need to be aware of this and informing and making sure someone is up to date with what needs to happen under these new rules. The other thing that looks like it's making some progress is the changes to the main residence rules for non-residents, so non-residents being carved out from the main residence exemption. A committee has looked at that, a parliamentary committee, and has suggested that the rules proceed, but with an education program around it, so that non-residents are able to make an informed decision around whether to hang on to property or sell it in the short term, because we've got a transitional period which will run up till 30 June 2019. So it does, again, it looks like these rules are going to pass through basically as they are. Hasn't quite happened yet, but keep an eye out for that, because it looks like that will happen pretty shortly too. So a fair bit going on, particularly around the CGT area, around property transactions as well. So quite a lot for practitioners to get their head around, make sure that they and their clients aren't getting themselves into risky situations from a tax point of view.
And that's the tax roundup for April. Thank you so much to all the practitioners that came to see us at the Accounting Business Expo at the Knowledge Shop stand, and particularly those that took part in our game show as well. You're a lot of fun. Thank you so much for that. And remember, Knowledge Shop is here to keep you on top of tax change. If you want to see what the membership offers, then give Julie a call on 1800 800 232, and we'll see you next month.